The carry trade is a trade people in foreign exchange market make when the interest rates offered by one country is higher than the interest rate offered by another country. When it comes to investing long term, you really have to understand certain macroeconomic forces to take advantage of these market opportunities. It is important to do fundamental and technical analysis for a specific stock, but you also need to understand the bigger picture, how the countries interact with each other, and how the foreign exchange market work. So in this video, I'm going to give you a crash course on what is the Japanese-US carry trade, how does that work, how did the Bank of Japan cause a market crash, and what I expect will happen going forward. So make sure you watch till the end. So let's get started. The carry trade is a trade people in foreign exchange market make when the interest rates offered by one country is higher than the interest rate offered by another country. So in this case, after increasing the interest rate, the US interest rate is 5%, and the Japan interest rate remains close to 0%. So if you sell the Japanese yen and you buy US bonds or US currency, then you can get 5% from this trade. And that's the carry trade. And this will lead to an outflow of money in Japan, a weakening Japan currency, and a stronger US currency, and which attracts capital to flow to the US market. Now here's my chart for the Japanese yen and US dollar, USDJPY. And what you'll notice here on the right hand side is that after Japan decided to increase interest rates, the currency went down, meaning that the Japanese yen got stronger. And then at this pin bar you see is when the Japan government decided to reverse the decision and put more optimism back into the market. So if you look at the Japanese index, you'll actually see a rebound, a very significant rebound for the last 2 weeks, but this is actually not happening in the yen, the currency, meaning that the people who decided to close the trade and buy back the Japanese yen did not really reopen that trade to try to capture the interest rate difference between US and Japan. And this is important because in the upcoming interest rate decisions, you'll still find that the interest rate gap between the two countries will be narrowing. So even if Japan doesn't increase the interest rate, but if the US government decided to lower the interest rate, that will also reverse the carry trade between USD and JPY. So ultimately, even though we're getting a bounce back in the short term, when the US government decides to decrease the interest rate, the Japanese yen will become stronger again, and this is going to cause another wave of panic, which may lead to the next market crash. So this is definitely something you should pay attention to. And if you want an update on this topic, then make sure you click like and subscribe.